Good evening, everyone. Myself, CA Mohit, Mm, Singhal, Secretary Gurugram Branch, and I welcome you all in today's webinar, which is jointly co-hosted by Gurugram Branch, Pune Branch, Ludhiana Branch, and Jammu and Kashmir Branch. We have with us all the four chairmen of the respective branch: CA Abhishek ji from Pune Branch, Ashish ji from Ludhiana Branch, Dheeraj ji from Gurgaon branch, and Lalit ji from J&K branch. I welcome all of them to the webinar. I also welcome all the listeners and the member who are going to view this webinar, which is going to be webcast in different four regions of ICI. To start today's discussion, I just request CA Abhishek ji, Chairman Pune branch, to please give him his welcome address and also introduce our today first speaker. Over to you, Abhishek ji.
Good evening, everyone. Members from Ludhiana branch and J&K branch of ICAI. Namaskar from Pune. Uh, First of all, I would like to congratulate Dheeraj ji for making it possible that NIRC and WIRC branches are doing joint event. Today's topic is international taxation. The webinar is going to be taken by Anshul Kumar and CA Rohinton Shinwa. This Finance Act 2020 has brought unprecedented importance to provisions related to non-resident. Uh, uh, CA Rohit Shinwa is going to take us through the topic on international taxation. I would like to take this opportunity to introduce him briefly. CA Rohit Shinwa is a Bachelor of Science from Bombay University and is a fellow member of our institute. He is a partner now as a corporate tax partner in one of the big four firms. He has completed around 20 years experience, including 5 years experience with Deloitte in Mumbai and as well as in Los Angeles. During his time in USA, he has served in the role of Indian tax desk for US firm. Currently, Rohinton he has worked with extensively in inbound and outbound client, assisting them with international tax planning. So with this, I welcome Rohinton Shinwa. He's going to take us through the topic of international taxation. I also welcome another faculty, CA Anshul Kumar. Mohitji.
Now I request Rohinton sir to please carry the session. Over to you, Rohinton sir.
Thank you very much. I'm just going to share my screen with the presentation. So just give me a second. So today's session is about the multilateral instrument, and um, the multilateral instrument is a highly technical topic for most members. Treaties, by their nature, tend to be very complex. And given the fact that we have attempted in one stroke to modify almost 3,000 treaties around the world, obviously the instrument that does that is going to be a complex instrument. Before I start with my presentation, I just wanted to give an overview of what all I'll be covering. So to begin with, for many of the members who do not actually practice international tax on a day-to-day basis, I thought it would be a good idea to give a bit of an overview and explain a little about the multilateral instrument and what led to the multilateral instrument. We'll then talk about India's position on the MLI and the story that has unfolded so far. And then we will dive into some of the treaties that are going to be modified as a consequence to the MLI. We refer to such treaties as CTAs. CTA stands for Covered Tax Agreements. We'll then look at some of the practical considerations that will now apply to Indian tax treaties, and also look at some of the key covered tax agreements, because there are few 5 or 6 agreements where most of us tend to have transactions with, and I'd just like to kind of
Sir,
touch
your
on
voice
that.
is not audible, sir.
Can you hear
Thank
me
you.
better now?
Yes, sir.
Okay. So finally, I want to leave behind a few talking points that are very relevant because clients are asking questions about that to us, and also because these are some of the things that as practitioners we'll be debating with our clients. Finally, we'll have some time to take some Q&A, so if you have any questions, please post them in the chat box. Let's start with the basic concepts first to begin with. What is the MLI? Now, as you know, there were a bunch of measures put into effect around base erosion and profit shifting, which were propounded by the G20 in conjunction with the OECD. Now, in order to give effect to those measures, the MLI has been formulated as the instrument of implementing all the changes around BEPS. So, say for instance, if under BEPS certain things were identified as being abusive, like treaty shopping, for instance, the MLI gives a framework for implementing the changes around treaty shopping within the BEPS framework. Similarly, dispute resolution has been identified as another area which needed the treaties to be modified, and again, the MLI steps in over there. Now, what is the legal concept behind the MLI? Now, a multilateral instrument is very unusual in the world of tax. We are used to bilateral treaties in the tax world, where one nation gets into a treaty with another nation. But multilateral instruments are not that unusual under international law. Because if you see extradition treaties, for instance, many of those treaties tend to be multilateral. Consequently, while it's a new concept for tax, it is not a new concept for the purposes of international law. And the idea behind a multilateral instrument is the ability, the simplicity of actually negotiating one instrument with consensus globally, doing one signature, and having one ratification. So the entire process makes things very efficient in that manner, because everything is done in a streamlined fashion and it's done once, as opposed to bilaterally, where for each country the same process has to be followed. It is also something which is it's the multilateral
Sir, your
instrument is
voice
not
is still not clear, sir.
okay. The multilateral instrument is better now. Hello.
Yes, sir. Yes, yes, sir. Yes, continue, sir.
The multilateral instrument is also something which is meant not to modify treaties but functions alongside treaties. So, what that means is that you are not replacing an existing treaty with a multilateral instrument, but you are supplementing the reading of the treaty alongside the multilateral instrument. Also, this entire concept comes down from the concept under the Vienna Convention under Article 33 of the concept which is there, which is later in time. That is, when a new treaty is entered, it tends to supersede to some extent the existing treaty. Finally, the idea is also to use the instrument to give various types of flexibility to the treaty partners. Flexibility in what ways? One, the current tax agreements, the covered tax agreements can be specified. That means a nation can decide whether or not to apply the MLI to its treaties or not. So, if a nation decides in its own sovereignty not to submit one of its treaties under the covered tax agreements, the MLI will not apply to that treaty. The second is that while there is certain strict standards which are called the minimum standards, which will apply regardless of any kind of choice. But even within those minimum standards, there are certain flexibilities built in. So, say for instance, when we'll talk about this more as we get into the presentation, there are minimum standards as to the applicability of the treaty to the resident. And those standards are set into the MLI. The third part is around the possibility to have choices to either opt in or opt out of a particular rule, or to give certain optional choices or alternative choices for certain provisions. For example, arbitration is a perfect example where there is a choice given to the people to opt for it. And then we come as to how these treaties will be compatible with the existing treaties and how one should read those treaties, and then actually putting them into effect. That is through a process of ratification and the formal entry into effect. So many times, different countries have different laws as to how an international obligation becomes binding in that country. For instance, in India, an international obligation has to be notified in by the president, and parliament has to approve its applicability before it becomes law. So every country has a process post ratification of coming into effect. And when it does come into effect, if it happens in the middle of the year, it can only apply to certain types of taxes. And when it applies from the beginning of a financial year, it can possibly apply to all taxes. So that is a broad introduction into the MLI, what it is, and the legal concepts behind it. So let's move on into what's happened so far. So, under the inclusive framework, almost 125 countries have been collaborating on BEPS, and the MLI is an outcome, as I said before, of that collaboration. Now, on the 7th of June of 2017, 68 jurisdictions, actually it is 67 countries, but 68 jurisdictions who actually signed the MLI to modify a large number of tax treaties that were entered into by them. And in fact, on that day, almost 1,050 odd treaties, or almost one third of global tax treaties, were in a single set modified by the signing of the MLI. Now, the MLI, after it was signed on 7th of June, and India was a signatory also, it came into force on the 1st of July 2018, and we'll talk about the steps of what it means to come into force. Till date, 41 of the signing jurisdictions have since deposited their instruments of ratification, acceptance or approval to the OECD Secretariat. So, a consequence of that is the agreeing of the list of reservations and notifications and the opt-in and opt-out provisions that each country has done. And that has to be ratified and deposited with the OECD Secretariat, who acts as a kind of a clearing mechanism for each of these treaties. Each of the nations also has to identify the CTAs for which the MLI will apply, and the MLI, most importantly, will result in a modification of the minimum standards, which is the treaty abuse provisions, which is Article 6 and 7, and the dispute resolution provisions, which is Article 16, which around the mutual agreement process. So both these two minimum standards are immediately applicable. Now, the flexibility which I spoke about earlier is to give choices to the various BEPS treaty measures to apply either the optional or the alternative provisions, or to apply reservations, which means to opt out of provisions or parts of provisions completely, which are, however, not part of the minimum standards. The minimum standards do not allow you to opt out. They do provide you with choices, however. So here's the history so far. We've already talked a little bit about it. So the signing ceremony was on the 7th of June. And since then, on the 1st of July 2018, the MLI officially entered into force. Actually, it entered into force when at least 5 countries have deposited their ratification instruments. On 13th of June 2019, the Government of India approved the ratification of the MLI, and the deposit of the ratification instrument was made on the 25th of June. And similarly, on the 9th of August, the Indian government also notified the MLI. Within 5 months of that, the MLI entered into force for India. And if because of that, effective 1st April, which is the first financial year, for withholding taxes, about 30 treaties, it came into force, and about 23 treaties for all other taxes as well. Now, the MLI provisions continue to have effect as more countries deposit their treaties. And as of Jan 2020, we know for a fact that a number of other countries have also deposited their treaties. And effective 1st April 2021, more treaties will consequently get covered as more countries deposit their ratification instruments. The most important thing that has happened from 1st of April 2020 is the entry into effect of the covered tax agreements. So 23 such treaties have been coming into effect post their ratification. And these are the names of the treaties that have come into effect. And for withholding tax purposes, because it comes in the middle of the year or it comes effective depending on the date of ratification, on the first day of the next calendar year following which the MLI has entered into force for each of the parties to the CTA. And India has chosen to substitute the word calendar year for the taxable period, and therefore we are taken to 1st of April of every year. So a bunch of very significant countries, if you see Netherlands, Russia, UK, Australia, France, Japan, Singapore, Sweden, and the UAE, some of our large treaty partners have now deposited, and that and those treaties are applicable to us with effect of the MLI. Now, pursuant to 2020, there are some treaties which will have effect only for the purposes of withholding taxes, or which will enter into formal effect in 1st of April 2021. So some of them, including Canada and Cyprus, will have a delayed implementation as we move along. So there have been a lot of questions that our clients have asked is what happens about the India USA treaty. Now, surprisingly, the USA has not signed the MLI, and consequently, the MLI does not modify the India USA tax treaty. There are various reasons for the US not signing the MLI, and the purpose of this presentation is not into getting into that. But suffice to say, the US treaty will still be considered on a standalone basis without giving effect of the MLI. Similarly, there are other treaties where either the treaty partners have not notified the treaty, or like for China, for instance, where it's a recent bilateral treaty, but which has incorporated certain principles of the MLI into the treaty itself, and hence both China and India have opted not to put it as part of the covered tax agreements. Similarly, countries like Switzerland, Germany, and Mauritius have opted not to put their treaty with India under the list of covered tax agreements, and therefore, under the matching principle, the MLI does not apply to these treaties. So, let's look now at some of the key impact areas. So, India has a total of 95 treaties, out of which 93 treaties have been put up as the covered tax areas. And uh, basically, these covered tax agreements has certain uh, prominent modifications which have been inserted into them. The first one is around treaty abuse. Basically, the biggest change over there is the insertion of the principal purpose test. The principal purpose test, along with the simplified limitation of benefits rule, is meant to act as a form of a guard which will apply from within the treaty, and we'll discuss this a little more. The second area is the widening of the PE scope. So, or rather, the narrowing down of the PE exemptions that currently exist in the treaty. So, the exemptions currently that exist around, say, for instance, preparatory and auxiliary, or uh, things around the agency PE, strengthening those provisions, those are meant to be covered under this particular area. The third is the improving of the dispute resolution process by making MAP to be implemented in a timely and uh, uh, consistent manner between the countries. The fourth area is there are some other key modifications around the application of a tiebreaker test in case of dual residence, and also around the taxation of capital gains by source jurisdictions, especially where those gains result from company shares that are real estate rich companies. So basically, the alienation of share of interest from immovable property. So all these are some of the changes that will now feature in some of the Indian covered tax agreements, and we will see how each of them will look like shortly. Let's start with the first article, which is Article 6 and 7 around the prevention of treaty abuse. So, as you know, in Azadi Bachao Andolan, the case before the Supreme Court, one of the findings of the Supreme Court was that the preamble of the treaty with Mauritius read that it was meant to supplement and incentivize business between the two countries, and the fact that it was highly successful in ensuring that investment went from Mauritius into India. It meant that the overall preamble of the treaty itself said that it was meant to incentivize such investment, and therefore there was no treaty shopping. Now, this particular interpretation by a Supreme Court of the preamble has now been specifically modified and covers specific situations where the preamble itself is made, the wording of the preamble itself is tightened up so as to make it uh, not refer to opportunities for creating either non taxation or reduced taxation. Now, this is a mandatory provision, and India has held no reservations against this particular proposal since it is a mandatory provision and something which India supports in the exact way in which it was propounded. The second one is around Article 7, which proposes to insert the principal purpose test and the simplified version of the LOB clause. Now, this again applies to all tax treaties, all the covered tax agreements, and as an option, India has opted for both the principal purpose test and the simplified limitation of benefits. Now, typically, the other country also has to match our, so it's a symmetrical matching which has to take place. So some countries may not opt for the LOB, some may opt only for the LOB, and some may opt only for the PPT. India has accepted the PPT as the interim measure, and where possible, it wants to implement also the LOB provision under all the covered tax agreements. So, what is the impact on our bilateral tax treaties? Firstly, the preamble will have an overarching impact, and any kind of no taxation or reduced taxation will go out from the language of the preamble, and hence reduced taxation will not be the intent of the treaty. Being a minimum standard, these mandatory provisions, both under Article 6 and 7, will apply to all the covered tax agreements. And the optional provisions, which regard to developing economic relations and enhancing cooperations, would not apply. Currently, only two treaties with Sweden and Luxembourg have their objectives as promoting economic cooperation between the two countries. This was held to be the deciding factor for the Supreme Court in Azadi Bachao Andolan case, which all of us know about. The India Mauritius Treaty also has a similar the provision which was discussed in Azadi Bachao Andolan, and that is the avoidance of double taxation and the prevention of fiscal evasion with respect to taxes on income and capital gains, and for the encouragement of mutual trade and investment. So, if the MLI were to cover that, then it would modify this preamble, but as of now, the India Mauritius Treaty is not a covered tax agreement because Mauritius has not opted to cover it. On the principal purpose test, I think a lot of discussion has happened as to the way the principal purpose test operates and how it will apply to a situation where even the LOB rule applies. So, as you know, under the principal purpose test, the purpose of the transaction is investigated, and if the principal purpose is to obtain a tax benefit, just like we have under our local GAR, the treaty benefit can be denied. On the other hand, the limitation of benefit rule is that if a person has structured himself so as to avail himself of the treaty benefit, and if he is not able to satisfy certain conditions specified under the limitation of benefits rule, then again the treaty benefit will be denied. Now, there are certain situations where the LOB rule and the principal purpose test can both apply, and essentially the words used are for the principal purpose is the resulted directly or indirectly in the benefit, and they're very wide, just the way it is under a GAR provision. So every time a treaty benefit is availed of, the first test that needs to be passed is the principal purpose test, and whether that benefit is consequent to the core commercial reason as to why that transaction was ever undertaken, and the bona fide intention of the transaction needs to be established before treaty benefit can be claimed. So the limitation of benefits rule is applicable in some of our treaties. So, like for instance, Russia, Slovakia, and Norway have opted for the simplified limitation of benefits rule. So there, that rule will apply. But there are many countries who have just gone with the PPT, which is the minimum standard. In some treaties, the like Australia, UK, UAE, and Singapore, there is also the additional option for the competent authority route under Article 74 for grant of treaty benefit. India, however, has not opted for this route, where the competent authority can disregard unilaterally the availability of the treaty benefit. There are some other considerations that also apply once, and these are some of the questions that we get quite often, is what is the impact of the grandfathering rule that applied for investments which were made before 1 April 2017? Now, as you know, there are treaties which are now covered under the covered tax agreements, such as Singapore and Cyprus, which were grandfathered under the grandfathering rule. Now, on the advent of the revised preamble and the PPT article, what will be the fate of the treaty under those circumstances? So, especially under the Singapore Treaty, Article 7.1 specifies one of the principal purposes being that of getting a tax benefit. And the question is whether Article 7.1 would apply or supersede the other provisions of the treaty or not. In the India Netherlands Treaty also, there is Article 35, which gives the benefit of uh, exemption from capital gains. And the question is if, under the right to tax for capital gains lying with the Netherlands, whether the MLI PPT will counter that for double non taxation or not. Remember, the Dutch do not tax capital gains, and question is therefore that if it is not taxable under the treaty because of the India Dutch treaty, it's not taxable in India, and also it is not taxable in the Netherlands. Owing to the new preamble and the principal purpose test, does that modify the double non taxation, which has always existed in that treaty? A similar sort of opportunity also exists under India Sweden Treaty, which exempts capital gains on sales of shares. So that brings us to the most important question as to what supersedes the other. Does the principal purpose test survive, or does GAR survive, or are both of them compatible with each other? Now, under our domestic law, Circular 7 of 2017 very clearly says that the domestic GAR can override the principal purpose test. So you might have met the principal purpose test under the treaty. However, under exceptional circumstances, the domestic GAR will override, in certain types of abuse situations, will override the treaty as well. Now, this does cause a little bit of uncertainty sometimes when implementing the treaty. But remember, both GAR and the principal purpose test are invoked in very exceptional scenarios. So, the question that comes up is whether in those scenarios, what happens to grandfathering and what happens to the application of the principal purpose test in the future in those sort of cases. So we already have one or two advance rulings which have held that the treaty does not apply in certain types of situations. Let's now supplement our knowledge with the help of a case study. Now, in this case study, Arco is a resident of a particular state R and has successfully submitted a bid for construction of a power plant. ESCO is a resident of state S where there is a construction project where the power plant has to be built, and Arco has contracted with ESCO to build the plant. Now, during negotiation, it was realized that the project to do the entire construction project would last a total of 22 months. And the project is therefore split into two parts, one for each under 11 months each. Contract one, which is issued to ARCO for 11 months, and contract two with SUBCO for another 11 months. Let's assume the threshold for uh, a PE in this particular case is a construction project that lasts for more than 12 months. So, in this case, we are also told that SUBCO was newly incorporated for only this project as a 100% subsidiary of ARCO, and ARCO is jointly and severally liable with SUBCO for all the contractual obligations of SUBCO on this particular contract too, which it has entered into with ESCO. Now, given this situation, the question is whether the principal purpose test can be satisfied and whether the benefit under the treaty for the 11-month threshold, the 12-month threshold, can be given separately for each of these two contracts. And this is a perfect example where the commentary says that the principal purpose test has failed in there because, in the absence of any other facts and circumstances, it would be reasonable to conclude that the only reason for having these two contracts is to ensure the benefit of the rule in paragraph 3 of Article 5, which restricts a PE under 12 months. So, granting the benefit of under these circumstances to a treaty means that this is an abusive transaction, and the principal purpose of this transaction is to only create a kind of avoidance which is meant to frustrate the treaty itself, and therefore the treaty benefit will not be granted in this case. So that was an example of principal purpose tests. Let's now move into Articles 12 to 14, which deal with the artificial avoidance of PE and the widening of the PE scope. So over here too, there are a number of changes that have been proposed both to the treaty and to domestic law. The first one is the widening of the agency P definition, which also now features in our section 9, where a person who habitually concludes contracts or plays a principal role in such conclusion, and those contracts are routinely concluded without any material modification by the principal, would be considered as an agent, as a dependent agent of the principal, and hence a dependent agency PE. Now, over here, the BEPS framework had proposed to lower the threshold, and India has given effect to that both under our domestic law as well as in a modification of the treaty. Now, this condition already existed in some of the treaties, but many of the treaties, it did not it was not there, and therefore the expanded scope will now apply to the treaties that have opted for these to apply. So the important ones like France, Japan, there the treaties it'll immediately apply. There are some treaties who have opted not to apply this condition, namely treaties with Singapore, UK, UAE, and consequently, there is still a little bit of room to play around. However, because of the domestic modification, one has to look at the marketing support services and commission model that many multinationals have in their supply chain. And over there, if there is a agency fee risk, one needs to revisit whether that model can continue under the respective treaty and whether protection is available under our domestic law or not. The other area is around the restriction in the overall definition of what is preparatory and auxiliary. And again, the there are two options given over there. India has opted to go with option A, which says that the specific activity exemption would be narrower and will be applicable only if all such activities fall within the specific activity exemption. So, say for instance, if the activity is partly preparatory and auxiliary, and there is some other activity as well, the preparatory and auxiliary character will not apply to that activity. And we'll look to an example going forward as well. The third area is the anti-fragmentation rule. And this is again something that came out in BEPS, where it was found that multinational companies fragment their activity to stay below the PE threshold. For instance, they would have toll manufacturing in one country, they would have a principal in another country, they would have a warehouse or a strip risk distributor in another country, and hence no country in which the activity is being carried out would actually have all the activities, and they would fragment out those activities. Now, now the proposal is that where such activities are purposefully fragmented in such manner, they would be combined overall, and they would be looked at in that cohesive fashion in order to disregard the artificial fragmentation that has been done. And again, we will look at an example shortly of this as well. So, what is the activities which are listed now in 5.4 of the OECD? 5.4 is basically the ones which is the negative list, where it says that these activities will not amount to a permanent establishment. So as you can see, these activities have now been severely curtailed. The preparatory and auxiliary rule has been made very specific. The anti-fragmentation rule has been brought into play to combine fragmented activities, and consequently a much tighter list of activities is allowed as an exemption from the definition of a PE. So, what is the effect of all these changes under Article 13 for fragmentation and specific activity exemptions? Some treaties, again, have opted for it, and some have not, both preparatory and auxiliary. This is a list of ones who have opted for both those conditions. Let's now move to an example to decide how the fragmentation actually works. Now, in this example, we have Arco, who's an e-commerce operator, and he has customers in state S. Arco directly sells goods in state S by shipping them to a warehouse owned or leased by it in state S. Now, the principal activity of the e-commerce operator is to buy and sell goods. The sale, no doubt, takes place through the internet, but the customers are in India, and the delivery function, which is earlier viewed as a preparatory or auxiliary activity. Remember, the preparatory and auxiliary rule allowed you for storage and delivery of certain goods so as to not constitute a treaty under the negative list. Now, under this situation, because of the anti fragmentation rule and because of the fact that the sales are actually happening in state S, ARCO can no longer take the benefit of the reduced treaty threshold that applies for preparatory and auxiliary activities and for delivery, uh, which is applicable currently under the treaty. So, in this case, it would trigger a PE. There are other areas where potentially this could also have an effect. For instance, where spare parts are delivered and after sales services are provided through a group entity, or in a toll manufacturing model where where the manufacturing happens and is considered under preparatory and auxiliary. Now, this normally doesn't happen in India, but it can happen in a OECD treaty country because of the way the OECD model is worded. Most of India's treaties will not have this issue. And finally, premises used for purchasing of goods for trading activity. So while we have an exemption for purchase for export, the anti-fragmentation rule will apply if sales are also done in the same country. So there are different areas where potentially this anti-fragmentation rule could apply to companies in India. We now move on to a situation where there is a splitting up of contracts on account of the treaty threshold. So we talked about it earlier as well. So where there is a specified treaty uh, threshold that is there for related parties, the lower threshold of 30 days will apply to it, and consequently again a splitting a contract into two parts between related parties cannot be used to avail oneself of the exemption of days which are provided under the treaty. Again, these options are available under some of the treaties, and some have opted to apply for it and some have opted not to apply for it. There are few other articles which are important to look at, like, for instance, the requirement for a minimum holding period for a shareholder to avail concessional tax rates under this covered tax agreement. So, say for instance, the dividends may sometimes be exempted under a treaty if the shares are held by a beneficiary who is a resident of a contracting state. However, it did not prescribe the holding period. So, what can happen is as soon as the dividend is paid, the entity in the covered tax jurisdiction would acquire the shares and will hold the prescribed threshold. So, in many of the treaties, there is a threshold of, say, 25% in order to avail of the reduced tax on dividends. Now, that threshold would typically be kept at 24.99 or above, and then just before the dividend is to be received, it will be increased to meet the threshold. So now the treaty prescribes for a minimum holding period in order to avail oneself of the threshold. So many countries have again opted in for it, some have opted out for it, and there are some reservations that have also been created. The last area that I'd like to kind of cover is the capital gains from alienation of shares emanating principally from the value of immovable property that those companies hold. Again, the criteria over there was that the at least 50% of the value of the shares had to come from immovable property. And many times, what would happen is that the shares were diluted, the value of the company was diluted so as to fall below the exemption limit just before the gains were made. And consequently, again, similar to the dividend condition, a additional holding period of 365 days has been added prior to the date of alienation, prior to the date of sale of those shares. So that's again another change that has been made. Some countries have again opted in for it, and some have opted out for it. And finally, the mutual agreement process, where India has reserved its right for not opting for the modified MLI provisions, but will subscribe to the bilateral process of MAP, which currently is ongoing as well. Corresponding adjustments is to apply corresponding adjustments to map additions which are made under the bilateral APA process and the map process. And India has actually made a circular which says that both on the bilateral APA and map, if there are these adjustments, they would be made regardless, even in the absence of Article 9.2. So this allows compensating adjustments to be made under certain situations. So what is the key impact on treaties? Well, in the India UK treaty, the biggest changes are around the principal purpose test and the anti fragmentation rule. The India Singapore treaty, we have already talked about a little bit in detail about how the principal purpose test will apply. And similarly, under in the India France treaty, the broader agency P rule comes into application. Under the India Australian treaty, the avoidance of P status through preparatory and auxiliary exemptions has been tweaked. The anti fragmentation rule has been inserted, and the splitting up of contracts provision has been made applicable. Similar changes have been made in the India Japan and India Netherlands treaty, all of which have come into effect for withholding taxes from 2020 and for all other taxes also from 1 April 2020. So these are some of the biggest treaty partners that India has. Of course, the US is a notable exemption from this list. So what are some of the key things that we are talking about? Both clients are asking us and what we are talking with them. First, the impact of the different entry dates of going into effect for withholding taxes and other taxes. So this needs to be monitored very carefully, as depending on the date, the effect date will differ for each of these. The current organization structure and transactions to satisfy the principal purpose test needs to be looked at. So, if, say, for instance, your client has a structure which goes through a particular intermediary country location, the question is whether the treaty benefit will apply to that intermediary country location or not is something that needs to be looked at. Because of the changes that have been made in the agency PE definition, the current business model and supply chain also need to be looked at as to how it impacts the broadened ambit of PE, and the grandfathering of investments for Singapore and Cyprus have to be looked at, not for Mauritius, because Mauritius is not a covered tax agreement, but that needs to be looked at as how that will play out. And finally, the double non-taxation argument, which applies in the case of a holding structure through the Netherlands and Sweden, which I touched upon in my earlier example. So these are some of the key points that are relevant for us. And I'll now pause to take any questions that might have come up in the chat.
Thank you, Raitan sir. Thank you. Thanks a lot for discussing in detail the several provisions related to MLI, sir. Though members are not posting any questions on the YouTube till now, sir. We request member if there is any doubt, you just can ask to sir via our YouTube channel. So there is one question. Hello.
Yes.
It's from Mr. Nitin Goyal. Whether minimum standard will apply to all DTA or only all those DTA which are covered by specific country.
Yeah. So in order for the minimum standard to apply, the minimum standard can only apply to the covered tax agreement. So the countries must opt in for the to have those covered tax agreements to be inserted and be signatories of the MLI. As soon as they become signatories of the MLI, the minimum standards become applicable to the particular country. So, say for instance, in the case of Mauritius, the grandfathering rule continues to apply to Mauritius because it's not a covered tax agreement.
Sir, next question is from whether MLI will apply from 1st April 2020.
Yes, so there is a time bound, uh, there's a timetable as to when the MLI becomes effective, and as soon as India deposits its ratification, and similarly other countries with whom India has treaties deposit their ratification documents. As soon as that happens, there's a time bound process by which the MLI becomes effective for those countries. So, in some cases, the MLI became effective in October itself. In some cases, it became effective from 1st of April.
All right, sir. Next one is if GAAR was there, then what was the need of for MLI?
So, GAR is a anti-avoidance rule that exists under our domestic law. Now, there is also a rule for taxing a PE under our domestic law. There's also a rule for having a business connection under our domestic law. But treaties modify that rule. So there is no such condition that if it is there in domestic law, that shouldn't be there in the treaty. The treaty can have a different standard, which may be lower or higher than the one prescribed under domestic law. And as per the provisions of Section 90, if the provisions of domestic law are more beneficial, then those will apply and precede those of the treaty. So both the treaty and domestic law are separate codes in that sense.
Perfect, sir. Sir, last question, sir. What effect does MLI has on LOB clause existing in Singapore Treaty?
Right. So basically, the LOB clause under the Singapore Treaty pertains to it's a very specific LOB clause. You require to have a particular physical presence in Singapore, and you have to have certain number of employees. You have to have certain amount of expense. But what has happened is that the principal purpose test has also come into play over there, and while the LOB clause coexists at the same time, the principal purpose test also needs to be fulfilled. And that gives an element of this as to how they will coexist. So, the LOB clause is very specific in the Singapore Treaty, and it's usually very easy to fulfill. However, the principal purpose test is far more difficult because it's more of an objective test that needs to be looked at the intention of what was the condition, whether there is a tax benefit and whether that tax benefit was the sole reason for doing the particular transaction. So I think the principal purpose test is the one that will, in going forward, be tested.
Sir, there are few more query and people are willing to ask, sir. And next one is in case of contradictory position between PPTs and the relevant article of DTA, what will override?
So once the agreement is a cover tax agreement and PPT being the minimum standard, the principal purpose test will override.
All right, sir. Next one would be, sir, are deductor required to assess the principal purpose of the transaction from vendor standpoint when withholding tax on payment in respect of service received from them?
So deductors are always put in a special position in India because the revenue views them as their mind and arms in the entire process of collecting tax. So I would say that under these circumstances, a DDO or a deductor has to make an objective determination as to whether the treaty will apply or not apply. That determination can be based on some representation he gets from the peer, but he must exercise due diligence in doing that process. To my mind, as long as the due diligence has been bona fidely exercised, the deductor should not be in a place where he can be held to be failing in his duty. So the question is, what is that bona fide this? And again, it depends on each situation.
All right, sir. I think all the questions we have covered during the session, sir. And there are last one. Is there any change in what rates from 1st April 2020? I think Mr. Gopalji is asking about the rates.
Uh, okay, so there are no changes in rates because the rates are not decided in the MLI. The rates are already there in the treaty. So I don't think the MLI has modified any of the rates. The rates were always there. So, say for instance, 5% withholding is there in a treaty. The MLI merely puts rules around when they become effective for that particular jurisdiction, but there is no change per se in those rates owing to the MLI.
Okay, sir. Okay, all right, sir. Thank you, sir. Thanks a lot for discussing in detail and taking several practical issues in respect to the international taxation, sir. Thank you.
Thank
Thanks a
you
lot
very
for
much.
joining us, sir. Now, I would like to welcome our next speaker, CA Anshul Kumarji. Welcome, Anshulji.
Nashar ji, well, thank you very much.
Before moving ahead, I would like to just give a brief intro of Mr. Anshulji, who is a BCom honors from Delhi University and a fellow member of ICAI. He has around more than 15 years of experience in corporate tax area. He has worked with Big Fours more than 13 years. Anshul has a vast experience of supporting various multinational companies in formulating their tax and transfer pricing strategies. He is also a co-founder of Startup Bazaar and he is delivering several lectures on different topics in relation to international taxation and direct tax area. I welcome Anshulji in this webinar and directly hand over this webinar to him to enlighten everyone with his knowledge, sir. Over to you, Anshul, sir.
Thank you, Mohit ji. Thank you for the kind introduction, and thanks you everyone, the participants who are participating in this webinar. I'll let me just share the screen with you. I have a presentation. So we will be today taking the session on the extended scope of equalization levy. We all know that equalization levy has been applicable since 2016, wherein there was an equalization levy brought in to tax some kind of advertisement spaces where the taxation was avoided by the multinational taxpayers. So the context of this is that we will go through what is the extent, which is the present scope of equalization levy, and then we will go through the extended scope which has been brought in by the Finance Act 2020. As you would remember that in the original finance bill, which was introduced in the parliament on 1st of February, there was no talk of equalization levy or the scope of being extended. But when the final Finance Act was passed, there is a extensive changes in the scope of equalization levy, and it has been extended. The payment mechanism also is quite different in the new extended scope of equalization levy, and there are some exclusions also which we will go through. There is some statement of equalization levy which will be required to be filed, and also what are the challenges which are posed by the introduction of this new scope of equalization levy. So we'll go through the background of equalization levy, that what it is. It was introduced in Finance Act 2016 as an alternate mechanism of taxation for digital transactions. As we are all aware, digital transactions generally do not get covered in the scope of permanent establishment. These transactions are conducted through virtual means, through websites, through other virtual means, and through mobile applications. And by the traditional definitions of permanent establishment, either in the domestic tax laws or in the tax treaties, we do not get the transactions covered so as to allow the source country to tax such kind of transactions. And therefore, in BEPS Action Plan 1, there have been certain suggestions which have been provided to tackle the digital economy and to allow the source countries to tax such kind of transactions. Equalization levy is one of that particular suggestion, wherein the source country was allowed, or it was suggested that source country can suo moto put a levy on these kind of transactions to tackle this. But India came up with this innovative way of taxing digital transaction, wherein a separate chapter in the Finance Act 2016 was introduced. So for your information, this is not an income tax. This is a separate chapter in the Finance Act 2016, just like there was a separate chapter in Finance Act 1994 for service tax. So there is no separate act which has been brought in, but a separate chapter in the Finance Act 2016 which was brought in. Now, how this operated by way of a withholding tax, similar kind of withholding tax, where the payer, if the payer is sitting in India, while making the payments, it would withhold the tax, which is called equalization levy, and deposit it with the Indian tax authorities. The equalization levy was charged at the rate of 6% on the earlier scope, and these services or the kind of scope which gets covered in the equalization levy, it was exempted from the income tax levy, and a specific clause 50 under section 10 was provided, which said that the scope which is covered under these transactions which are covered under the scope of equalization levy would not get taxed under the Income Tax Act. Now, what were the services covered? The services were specified in nature, and it meant services which are online advertisement or any provision of digital advertisement space or any other facility or service for that purpose of online advertisement. So the scope was very limited. Basically, these were targeted to cover social media companies which were providing a lot of advertisement space and earning a lot of money from Indian advertisers. So for example, if Indian advertiser is making a payment to a foreign website which is based in somewhere in Ireland, the transaction would not have been covered under the normal provisions of income tax, because the foreign company in Ireland would not be considered to have a permanent establishment in India. And because such kind of payment of advertisement fees was in the nature of business income for the foreign company would escape taxation in India, because they would say that we do not have a permanent establishment and therefore this income is not taxable in India. However, after the introduction of this equalization levy, the payer would be required to deduct a 6% withholding tax and deposit it to the Indian government. There were some exclusions from the earlier scope of equalization levy, which was that if the foreign non-resident company has a permanent establishment in India and these specific services are being provided are effectively connected to such PE, then there will be normal taxation which will happen as per the income tax law, and it would not get covered under the equalization levy scope. Also, if this payment was being made for a personal use and was not for any business purpose, then also equalization levy was not to be levied. And further, the threshold limit was prescribed of 1 lakh rupees, that if an advertiser from India is making a payment of rupees 1 lakh or more, then only equalization levy would apply. So 1 lakh would definitely apply to each advertisement space. Say for example, if website 1 I am paying 90,000 and website 2 I am also paying 90,000, then although my expense on advertisement to foreign non-resident space providers is more than 1 lakh, but towards each of the websites it is less than 1 lakh. Therefore, the equalization levy will not apply to any of them. Now, government thought that this particular equalization levy was not sufficient, and therefore, in Finance Act 2020, they have increased the scope to the lot bigger transactions. How it is applicable now is that it is applicable to an e-commerce operator. What is an e-commerce operator? E-commerce operator means a non-resident who owns, operates, or manages digital or electronic facility or platform for online sale of goods or online provision of services or both. So you can see that this particular definition of e-commerce operator is very wide, quite wide. So any kind of services which are being provided by the non-resident e-commerce operator through the digital platform, even if he operates or if he manages the digital platform or electronic facility, even then the e-commerce operator will be covered under this particular scope. Now, what is the scope of supply? The e-commerce supply or services made or provided or facilitated. So even if I'm not providing the services or not making the supply of goods directly, even if I'm acting as a marketplace, a foreign marketplace, whereby I am say for example, a marketplace in US, wherein some sellers are based in USA and they are selling the goods through that particular marketplace, and I as a customer from India orders the goods from that particular marketplace. Now, when the goods are supplied to me, even though directly by the supplier of goods, but I am making payment to the e-commerce platform, this transaction would be covered under the definition of new scope. Now, what all transactions are covered? So, e-commerce covers if the services are provided or facilitated to a person resident in India, to a person to a non-resident person in specified circumstances. So say for example, if e-commerce operator is a non-resident and the user of the e-commerce platform is also a non-resident, even in those circumstances, the transaction can be brought into the scope of equalization levy in India. We'll come to the next slide and discuss this specified circumstances. Now, third condition is that to a person who buys such goods or services or both using an internet protocol address located in India. What does this mean? So, say for example, if a traveler has come to in India for say personal visit, maybe a tourist who has come to India for personal visit, but while being in India, he accesses the websites of his home country and orders those goods for his home country use, not for India, but home country use, and the e-commerce operator accepts that order, then because the order was placed using an IP address located in India, this particular transaction can get covered under the scope of new equalization levy. Now, what does e-commerce supply or service means? E-commerce supply or service means online sale of goods owned by the e-commerce operator. Say, for example, if I am the website operator and I am myself supplying the goods. Provision of services provided by e-commerce operator. I am the operator of the e-commerce platform and I am myself providing the services on that platform. Or online sale of goods or provision of services or both facilitated by the e-commerce operator. Say for example, if I am the e-commerce operator, but I am not either selling the goods nor providing the services, but I am an aggregator of services wherein some sellers of goods or services come to my marketplace and offer their products and services through this platform, then also these transactions will be covered in the scope of equalization levy, or any combination of above three. All these transactions will get covered under the scope of equalization levy, which is the new scope of tax. Now we discussed that a transaction between two non-residents can also be covered under the scope of equalization levy. What are those circumstances? So first one is sale of advertisement, which targets a customer who is resident in India or a customer who accesses the advertisement through IP address located in India. So what does this mean? Say for example, we discussed a website which is located in say Ireland, and a seller of goods or services which is based in say for example USA. Now the seller wants to target the customer base of India and wants to advertise the things on the platform owned by Ireland company with a specific purpose that the customers based in India must be targeted and the advertisement must be showcased to them. Now this particular transaction, the target audience is based in India, and therefore what the law provides is that such kind of transaction would be covered under the scope of equalization levy, and therefore uh, the non-resident platform owner will be governed by the scope of equalization levy. Similarly, we have seen that the social media platforms collate a lot of data. They have a lot of database which they gather from the activities which we perform. And if we as a user in India are sitting and accessing these social media platforms or many other platforms for that matter, we leave behind a lot of information with them. This information is quite at times used for selling to other business users. They sell it to maybe some marketeers. They may be used for some data analysis. They can be sold. This data can be sold for various purposes, and as we know that data protection rules are not so stringent in India as of now, and therefore the data is quite freely sellable in the market till now. Now what this particular scope means, that if some non-resident is buying certain data from a non-resident e-commerce platform, but that data is of the users based in India, then this particular transaction will also get covered under the scope of equalization levy. Now, how it is going to be paid? As we just discussed, that in the earlier scope of equalization levy, it is the payer from India who is required to withhold a tax of 6% and then pay it to the government. But now what we have seen in the new scope of equalization levy, it is not always possible that the payment would be going from India. As we have discussed that the transaction can be between two non-residents also. Now when the two non-residents are performing a transaction, it might not be very uh, easy for the government to track the payer who is not in fact connected in any manner with India, but it may be little bit easier, may not be fully viable, but it may be little bit easier for the government to capture and track the e-commerce platform who are targeting customers in India, because ultimately they have some base, they have some operations which are helping them to target the customers in India. And therefore, how this particular equalization levy is going to work is that the e-commerce platform operator will have to pay a 2% levy on gross basis of his income, which the e-commerce operator has earned from all the transactions which are covered under the scope of equalization levy. And I'll just go back to the scope. So what the scope is, that if e-commerce operator is earning any income from e-commerce supply or services which are made or provided or facilitated to a person resident in India, to a non-resident in specified circumstances, or to a person who buys such goods or services or both using internet protocol address in India, in those circumstances, that whatever revenue the e-commerce operator is earning from all these transactions, he'll have to calculate that and pay a 2% on gross basis of equalization levy to the Indian government. Now this change is applicable from 1st of April 2020 itself. So as we stand and as we talk, we are already having this particular law applicable. What is going to be the payment mechanism? So as I discussed, that this payment is going to be made by the e-commerce operator himself. So it is not a withholding tax mechanism. In fact, it is a kind of advanced tax mechanism. So as you earn, as the non-resident e-commerce operator will earn money, he will have to calculate the tax of equalization levy and deposit the same with the government. What are the dates prescribed? It is to be paid in quarterly installments. The payment dates is for first quarter 7th of July, for second quarter 7th of October, for third quarter 7th of January, and for fourth quarter 31st of March. Now how does it work? Say for example, in income tax, the advance tax is to be paid on the basis of entire estimation of income for a particular year. But how this particular provision is being mentioned is, and how it is written in the law, is that you'll have to calculate your revenues in first quarter, which you have earned already through the transactions which we just discussed, and calculate 2% levy on that, and then deposit it. So basically, there is no percentage of a total revenue which you are expected to earn in the full year. You are not required to estimate your full year revenue out of this. You are only required to effectively calculate and compute all the revenues which you have earned from 1st of April till 30th of June, and calculate a 2% equalization levy and deposit it with the government. Same would apply for second quarter, and same would apply for third and fourth quarter. However, the difference in the fourth quarter is that the payment is required to be made within 31st of March. So there is no impact extended period. So for example, in withholding tax, we get an extended period till 30th of April. However, in equalization levy, there is no extended period. In fact, the period is curtailed. You'll have to calculate the revenues earned till 31st March on 31st March itself and deposit a 2% levy to the government by 31st March itself. So therefore, this seems to be a little impracticable as of now, but this is at this days what the law stands today. Now there have been provided some exclusions also from the scope of new equalization levy. So just to give you a wrap up of what we have discussed till now is that now there are two buckets of equalization levy. The two buckets of equalization levy are one which operates in a manner similar to withholding tax, the other which operates in a manner similar to advance tax. In the first bucket, the sale of advertisement space or any other facility similar to that, or any provision of advertisement in any service related to advertisement is covered. There, only the resident payer making the payment, while making the payment, will have to deduct 6% and then pay it to government. Whereas in the new scope, the liability to pay 2% on gross basis is on the e-commerce operator itself. It is on the non-resident e-commerce operator and not on the payer of those services. So therefore, we must now keep in mind that these two separate buckets are available, and to whom a withholding tax kind of a thing will apply, and to whom the advanced tax kind of mechanism will apply. Now coming on to the exclusions. Exclusions are similar to the earlier one, where the e-commerce operator has already got a P in India, permanent establishment, and such e-commerce of supply or service is effectively connected with the P. Now, if there is a P, obviously the taxation will happen as per the normal provisions of Income Tax Act on net basis and not on gross basis. Further, the equalization levy, this new scope of equalization levy, will not apply to the already existing scope of sale of advertisement, which is covered under the first bucket. So now these two buckets are mutually exclusive. So for example, if an e-commerce operator is providing services or supply of goods also, but that e-commerce operator is also providing some advertisement space for sale, then for the sale of advertisement space, the payer will have to withhold tax. Whereas for the supply of goods or services by the e-commerce operator, or any sale or supply of services through that e-commerce platform which are facilitated by that platform, will be covered by the new bucket. So these two are mutually exclusive and not overlapping. Thirdly, there is a threshold which has been prescribed that e-commerce operator should earn at least 2 crore rupees during a year so as to this new scope of equalization levy to get applicable on them. Until and unless this threshold is crossed, the equalization levy will not apply. There is a statement also which is required to be filed. It is required to be filed by 30th of June. Probably a new form will be prescribed for this particular new scope of equalization levy, and we'll get to see that what kind of form will be required to be filed. And also it is not clear as of now that whether the PAN number will be required to be obtained by the non-resident e-commerce operator, or whether there will be a separate kind of form which will be provided, just like we get to deposit taxes for TDS on sale of properties or TDS on rent for individuals. So there the only PAN numbers are required, the TAN numbers are not required. So similarly, for this kind of payments, probably government may come up with a new mechanism to pay the taxes. Now we'll come to challenges and what is the way forward for the new scope of equalization levy. There are going to be multifold challenges in the implementation of this particular extended scope of equalization levy. The first challenge is that the e-commerce operator which is covered in this scope is the non-resident. They are not resident, and maybe in many circumstances these non-resident e-commerce operators may not have any kind of fixed base in India or any kind of presence in India whereby the government can particularly catch hold of them. So it will be a challenging situation as to how the government is going to tackle this situation, but at least a new levy has been brought in, and probably through RBI mechanism, when the payments are going out, there may be some mechanism brought out to cover these kind of payments. The other thing is that if we have understood the scope of levy, say for example, we get a lot of software imports through websites. Most of these softwares are now imported into India through digital platforms itself, and we hardly see that any CDs or any hard copy material is transported or shipped into India to use the softwares. And we are provided with a access key wherein we log in and download the softwares. Now these softwares have been constantly litigated by the department that this is taxable as royalty payments, and thus it should be covered under the scope of taxation under the normal provisions of Income Tax Act, read with the tax treaties. Now we will be faced with a challenge that such kind of download of softwares will be covered under the scope of equalization levy, because the e-commerce operator includes any kind of digital platform. So the download of softwares through these electronic platforms might be considered as, or will be considered as covered under the scope of equalization levy, and therefore what would it mean that the payer from India would be relieved of his liabilities from withholding tax? It is something which needs to be seen. Also, what has been done in scope of section 1050, which is the exemption which is provided for the transactions which are covered under the scope of equalization levy, there is an ambiguity in the language. So although the scope of equalization levy has been implemented from 1st of April 2020, I'll just move on to the other part, the Finance Act, and I'll read out to you what is the ambiguity. So if you can see, this is the language which exempts the scope which is covered under the equalization levy from income tax. It is clause 50 of section 10 with effect from first day of April 2021 for the words comes into force, the words, figures and letters comes into force or arising from any e-commerce supply or services made or provided or facilitated on or after first day of April 2021 shall be substituted. Now, what does that mean? This means that although the equalization levy has been imposed from first day of April 20, but the exemption from income tax has been provided for supplies made after first day of April 2021. So what we can see is that there is an overlap of 1 year where both the taxes seem to apply. That it means that we would be faced with a challenge that while making a payment for certain services which we obtain from digital platforms, how would we deduct tax? Whether we would also, whether these kind of transactions will be covered under two tax regimes. That is, one is the income tax regime, where probably there might be some transactions which are covered under the royalties or which are covered under the definition of fee for technical services, or whether it will also be covered by the new scope of equalization levy. So this is going to be a challenge, and probably some clarification must be issued by government in this regard. And as of now, we must be very careful while issuing Form 15CB that whether the transaction is happening or has been undertaken through a digital platform. We must ask from the clients about the details of how the transaction has been undertaken, and therefore thereafter decide whether the taxation under the normal income tax provisions will apply or whether the provisions of equalization levy will apply. How it matters is that if the provisions of equalization levy apply, then probably the payer from India is not under an obligation to withhold tax on this particular amount. Now, another challenge which happens is that many multinational corporations have their head offices or the parent companies who subscribe to a lot of global services on behalf of all the subsidiary companies in the group. Now, what happens is that many times IT services or online softwares or the operating softwares of computers, they're all subscribed through the parent company. Now, the subsidiary companies from India or overseas might be making payment to the parent company rather than making any payment directly to the service provider. Now, as far as the plain reading of equalization levy goes, any service which is provided by the service provider through digital platform. Say, for example, if in India we have a subsidiary and having 100 employees, and say, for example, if a software is to be used by all these employees, which is downloaded through the digital platform. Now, this digital platform is owned by a particular e-commerce operator, but the payment is not being made by the Indian subsidiary. The payment is being made by directly the parent company. In this particular circumstance, the question is, how would the non-resident e-commerce operator get to know that the software is being used in India? Probably he'll have to make some firewalls so as to identify that the particular software has been downloaded in India or using the IP address located in India. This is a big challenge. Somewhere, we also find that the multinational companies operate their own websites, their own branded platforms, wherein they allow the users to visit each subsidiaries or access the each subsidiary. Or they might also have some of their internal softwares which are provided to subsidiary companies. Now, when these softwares are provided to the Indian companies, there may be a challenge that when we are making a consolidated payment for all the managerial services or all the corporate services, it might be a difficult task for the non-resident parent company to bifurcate the price between various services. Basically, all those services which can qualify under the scope of equalization levy and where the non-resident parent company can become an e-commerce operator, vis-a-vis some other services wherein the services are being provided over phone or other through normal policy making or some other guidance. Those kind of services may not still be covered under the equalization levy. However, the charge, which is cross charge to the Indian subsidiaries, is on a gross basis, and therefore there might be a challenge in segregating the prices amongst these services. So we have discussed this on third-party e-commerce operators. MNEs will also have to put in IT systems. Now, why IT systems are required to be made robust? Because we have discussed that sale of advertisement space using the IP addresses located in India, or the data which is used in India, right? Data which is generated out of the users based in India. Those kind of databases are also required to be captured under the scope of equalization levy. So for big multinational companies who want to be on the right side of the law, they would require to comply with the obligations put on them, and therefore they might be required to tweak their system so as to identify that which data belongs to which territory, and in that particular manner they will be able to segregate the fee. Say for example, if somebody sitting in USA is going to ask a website based in Ireland that you provide me data of Southeast Asia. Now in Southeast Asia, probably many countries might get covered: India, Pakistan, Nepal, Bangladesh, Indonesia. Whereas the equalization levy scope will apply only to the data pertaining to India. Now, if the website has taken a consolidated charge for the entire database which they have provided access to, they will be required to determine that what is the price which is required to be allocated to the database in India. So therefore, this is something which is going to be a big challenge, and they'll need to see how the IT systems are made more robust to capture all these data. Then moving forward, EL would be required to be paid even on supply of services which is consumed by non-resident while it was booked in India. So say for example, if a person is only on travel, only on a tour, only on short-term visit in India, but while being on this short-term visit, they particularly order for a supply or sale of goods, then that data also needs to be captured. Moreover, what happens is that many a times, sometimes it happens that the foreign companies have their service or IP addresses located in India. Say for example, if a company is based in Europe, it might use the IP address which is located in India. So the servers may still be located outside of India, but just for better connectivity or just for making some alternate arrangements of connectivity, the IP address based in India might be used to access the servers. In that particular scenario, it will be very challenging for the non-resident companies to identify that what kind of revenue should be allocated to India and what kind of goods and services have been ordered using that IP server located in India. So these are the challenges. Moreover, in equalization levy, as we have discussed, that this is not a kind of income tax. So whatever tax, this 2% tax, the non-resident e-commerce operator will be paying in India, it may be difficult for them to claim a foreign tax credit in their home country. So this is also going to be a cost for them probably if the home country is not going to provide a foreign tax credit against their income tax which is payable in the home country, and then this is going to be a dead cost for them and not creditable. So these are, as of now, what I have to share my thoughts. I would be happy to take queries.
Thank you, Anshulji. There are few queries which I want to share with you. First one would be, if there is a B2B transaction, does payer need to deduct TDS in spite of EL applicability?
Sir, as I mentioned, the income tax section 10 clause 50 exempts all the transactions from income tax which are covered under the scope of equalization levy. So to my mind, there is no requirement of deducting TDS as of now. However, for one particular year, that is for financial year 2021, there is an ambiguity because of the change in the language. The language as of now considers only the supplies which are made after 1st of April 2021. This point has been highlighted to government representatives in earlier webinars, and they have taken note of. So let's see and wait for some clarification which comes in. But after 1st of April 2021, the position is very, very clear. You will not be required to withhold TDS which on the transactions which are covered under the new scope of equalization levy.
All right, sir. Next one would be, sir, if Indian agent working for a non-resident as a travel agent and collected booking amount on his behalf, that is on behalf of non-resident. So while reimbursing collected booking amount, is EL applicable?
Just give me a moment. I'm just reading it out.
Oh, sure, sir.
Travel agent and collecting booking amount on behalf. Sir, to my mind, if the travel agent is booking the tickets, so to my mind, it is not an e-commerce, right? So if you are not booking through e-commerce platform or digital platform and you are using the services of a travel agent, then it should not get covered under the equalization levy until and unless the travel agent is also using an e-commerce platform which is provided by the non-resident operator. So if the tickets are booked by the non-resident by the travel agent sitting in India using the digital platform which is provided by e-commerce operator, then equalization levy should apply.
Next one would be, sir, will there be any requirement for these e-commerce operator to file income tax return under section 139 of the Income Tax Act?
Only if they are earning any other income which is chargeable to tax as per the normal income tax provision read with the double taxation avoidance agreements. So if these e-commerce operators are earning only the income which is covered by the scope of equalization levy, then there will be no requirement to file an income tax return.
Okay, sir. Next one would be, sir, will it apply to e-commerce outside India booking hotels for foreigners in India? Will it be on total amount or on net amount?
So what I can understand is that a non-resident is booking a hotel which is based in India, right? But the non-resident is booking for himself, but using the IP address which is based outside of India itself. To my mind, this kind of transaction will not get covered because the user, the booker, means the user is situated outside India. He has used the e-commerce platform sitting outside India. He has used the IP address which is based outside of India. And then the e-commerce operator is also situated outside of India. So just because the hotel of India has been booked, it might not get covered under the purview of equalization levy. However, what it may happen is that e-commerce operator might charge some commission from Indian hotel on this particular transaction. Now, this commission which he earns, the non-resident e-commerce operator, this commission income should get covered under the purview of equalization levy.
Next
And
one
it
would be,
will
sir.
be just one more moment.
Sure, sir.
It will be taxable on gross basis, not on net basis, because equalization levy is always on gross basis.
All right, sir. Next one would be, sir, how do we calculate the threshold limit of 2 crore?
It is basically we must see the transaction, the scope of transactions which we are, just allow me to share my screen again. So this is the scope of services. One need to analyze that whether the transaction is getting covered under any of this scope and whether the supply or service is falling within this purview. Then we will have to cover this under equalization levy, and once the transaction gets covered under equalization levy, we'll have it exempted from the normal provisions of Income Tax Act.
All right, sir. Next one would be, sir, whether any credit can be claimed under DTA by non-resident in their country.
See, to my knowledge, as of now, the foreign tax credit, the income tax is defined. In every DTAA, income tax is defined to mean certain things, and income tax is generally defined as the tax which is levied under the normal income tax provisions or normal income tax laws of a particular jurisdiction. how this equalization levy has been brought in. The government has specifically made this provision outside the scope of Income Tax Act because they don't want equalization levy to get covered under the benefits of benefits of double taxation avoidance agreements. If it were to be treated as income tax, the non-resident taxpayers will then try to cover it under the provisions of DTAA and then again apply the provisions of permanent establishment and claim that it is not taxable until and unless a PE is existing. So therefore, the government has purposely kept it outside the purview of Income Tax Act. To my mind, the foreign taxpayers may not be able to claim it. However, there might be change in the local tax laws of certain jurisdiction. To my mind, as of now, I have not come into knowledge of these kind of changes. Therefore, I mentioned in my last slide also that claiming of foreign tax credit might be very difficult. So this is the point which I mentioned. Non-resident e-commerce operator may face challenge to claim tax credit of the equalization levy in its home country. Yes, sir.
Next one would be the with respect to in-house software development. With respect to in-house software development by a parent company and charged to Indian subsidiary, and Indian subsidiary charges TDS considering FTS, would still EL apply?
Sir, which is this query? Can you
This
highlight
query
it?
is Mr. Varun Agarwal, sir. He is asking this query. This one, sir. It's on your screen.
Yeah. Sir, if the software is provided through an e-commerce platform, through a digital platform, right, then probably this may get covered under the scope of equalization levy. As I mentioned that the scope is very wide, very wide. Any kind of digital platform is covered. Mohit, kindly allow me to share the screen.
Sure, sir.
So if you can see the non-resident who owns, operates, or manages digital or electronic facility or platform for online sale of goods or online provision of services or both. So if a parent company is operating an electronic facility or digital facility for online provision of services to its subsidiary companies in India, these particular transactions will get covered under the scope of new equalization levy, and therefore, barring the ambiguity in section 10 clause 50, these transactions would not be taxable under the provisions of normal income tax act.
Next one would be, sir, from Mr. Mayank Gupta. A non-resident operator would be required to pay EL on its margin only or on gross value.
On gross value. This is very
As
clear
in,
in the law.
okay. As in some, his margin may be less than 2%. In some
So,
cases,
as of now, the law states very clear that he has to pay the tax on gross basis. I understand his point of view that he may have to pay the supplier of goods and services in the kind of marketplace where the marketplace is there. But to my mind, the non-resident will have to tweak its payment terms towards the vendors, and therefore, as of now, the plain reading of law states that it has to be paid on gross basis on the receipts.
so next one would be, sir, will just a second. Will EL be applicable on the cross charge paid to the parent company for centralized services received like telecom, IT?
Nikhilji, this is a good question, and this is one of the biggest challenge which would be there for the parent companies and the consolidated services which we receive from the parent company. As I mentioned in the presentation, it would be an onus of the foreign company, to determine what the kind of charges are there. They'll have to put in robust IoT systems to track orders or booking which have been made outside using the internet protocol, right? There is this one also, the multinational enterprise which collect consolidated charges from their constituent group entities will be required to segregate the charges which may be subject to EL. So what it means is that, say for example, there are certain services which are provided physically, right? So which is the guidance, which is the management guidance, or some directorships which have been provided, or certain kind of policies which are provided to the groups. Say we in multinational organizations which we have group policies, group HR policy, group IT policy. Now, if these policies are provided through internet, say for example, if there is an intranet or inter company portal which has been provided, and all the policies, all the material, all the marketing material has been put on that particular portal, and all the subsidiary companies, including the Indian subsidiary, is accessing that particular digital platform to access all the policies or material, then it may be argued by the tax authorities that this is something which is covered under the provision of the scope of new equalization levy. However, if the services are provided physically, say for example, certain meetings or certain consultancy services, if they are provided other than digital means, they might not get covered under the equalization levy scope, and they might be required to be taxed as per the normal provisions of income tax. So what we need is a pure, very clear bifurcation of charges for all these services, so as to segregate the levy of equalization levy vis-a-vis the levy of income tax under normal provisions.
All right, sir. So next one is from Lalit ji from Jammu and Kashmir. Employee of Indian company goes on foreign trip and make purchase online outside country, say hotel etc. But expenses were reimbursed by the Indian company. Whether EL applicable on such kind of transactions?
Sir, एक बार highlight करेंगे?
Sir, it's on StreamYard, sir. It's not on YouTube. You just see on the StreamYard.
Goes on foreign trip and make purchases online outside the country, say hotel, etc., but expenses are reimbursed by the Indian company. Sir, what we need to see is we need to see the transaction, how it has happened, whether the transaction has happened using the digital platform or not, and whether the transaction has happened by using the Indian IP address. Now, very plain reading of equalization levy as of now would see that if I as a resident go outside of India, say for example I am on a tour in London, and now I use the internet services there, say for example local Zomato or local food online processing services, and they deliver some food to me. Now, as per the scope of equalization levy, very literal scope, it will get applied. So, Mohitji, can you just allow me to share the screen again?
Sure, sir.
So, if you would see the first thing, e-commerce supply of services or made or provided or facilitated to a person resident in India. But this would be extending the scope too much, because while the non-resident e-commerce operating is sitting outside India, he is not able to determine whether a person who is touring that country is either a resident of India or not. So on a practical standpoint, even from a nexus standpoint, I would practically discount this particular transaction, and the e-commerce operator may not be liable to tax. But literally speaking, income tax authorities can go to any extent. We'll have to see how it applies.
All right, sir. Sir, next one is from Mr. Raja Jindal. If EL needs to be deducted on gross basis, it may be double taxation, as there may be Indian supplier on whose payment EL will be deducted.
Sir, it may not be double taxation, because first of all, it is not deductible. It is going to be a payment made by e-commerce operator only. Secondly, if we are saying that e-commerce operator is a non-resident and the supplier is a resident, then what we are saying is that the resident supplier is first providing the goods or listing the goods on a non-resident platform, and then some Indian user or a foreign person sitting in India is availing those services. First of all, this is very transaction is not possible to my mind through a FEMA perspective or through a supply chain perspective. So secondly, the supplier of services, for example, I am the supplier of services, non-resident may not withhold taxes on my payments. right? Because he is a non-resident supplier, e-commerce platform. So whenever the non-resident supplier is making payments to me, probably to most of the circumstances, I would be receiving it without any TDS. Whereas e-commerce operator, which is sitting outside of India, was not paying any kind of tax on all the earnings which he is making through supplier also, which is based in India, and the user also based in India. Now government wants to capture these kind of transactions and tax the e-commerce operator on such income. And therefore you would see that the tax rate is very minimal, 2% only.
All right, sir. Sir, next one would be if a digital marketing company based outside India cater to clients in India without having any establishment in India, with the help of employee based in India, will it be covered in EL?
So first of all, we'll have to determine whether there is a permanent establishment in India or not. Because if we are saying that the employees of a foreign company are based in India, then it would be very difficult to say that that company does not have a P in India, right? So first of all, we need to determine whether there is a PE or not. However, if there is no PE, equalization levy will apply. If there is a PE, the normal income tax provisions will apply. There is a specific exclusion out of the scope of equalization levy that if a non-resident e-commerce operator has a permanent establishment in India and the supply of goods or the supply of services through digital platform is effectively connected to that PE, they should be excluded from the scope of equalization levy and covered under the provisions of normal income tax act read with the treaty. So therefore, sir, to answer your query, first and foremost consideration of yours will be to determine whether the presence of employees in India will create a PE in India or not.
Last one would be so for Indian buyer, it is better to treat transactions covered under new equalization levy rather than getting caught under TDS.
Sir, it is a double-edged sword. As we mentioned that in some cases it may be a good idea to say that yes, 10%, 2% is better than the 10%. But if we look from another angle, 10% is creditable, might be creditable under their own hands in the against the taxes payable by them in their home country. Whereas the foreign tax credit may not be, the equalization levy may not be creditable. So it may be an extra cost over and above. So whereas, say for example, if a foreign company is earning 100 rupees from India, now if 10 rupees is deducted out of this, the foreign company will receive 90, but of that 10 rupee, they will also claim a credit against their taxes payable in the home country. Whereas if the company were to receive total 100 rupees, they will pay the taxes in their home country on the entire 100 rupees as per their normal tax provisions, whereas also pay 2 rupees to Indian government over and above that 100. So the ultimate cost of 2 rupees may not be creditable. So we need to see situation by situation as to where we will fall and whether equalization levy is better or whether TDS is better, but we'll not have any choice probably. We'll have to see the transactions, the scope of transactions. If it get covered under the equalization levy, we may not have a choice to say that no, we don't want to get covered under equalization levy and we want to be governed by the earlier provisions of Income Tax Act. So that benefit may not be available. It's not an option given to the taxpayer.
Well explained, sir. Last one, sir. Can the payments where FTS is payable at the rate 10% be covered under EL?
Yes, sir. It can be if the services are provided through digital means. If digital platform is used to provide such services, and if we can say that the provider of such services becomes an e-commerce operator, because the definition of e-commerce operator is very wide. So such FTS can also get covered.
Okay, all right, sir. Though we have completed all the queries, sir. Sir, members are asking for your number. If you feel comfortable, please share
Yes,
your
sir.
number with them, sir.
Just hold on. I have it on my slide.
I just request you to please speak it also, sir, so that member can note it down, sir.
Sir, the number is 9899 784 884. I will repeat. It is 9899 784 884.
All right, sir. Thank you, sir. Thank you, Anshul ji, for discussing in detail several provision in respect to equalization levy. It would be great for every member throughout the different branches which are jointly co-hosted this webinar through different area of India, sir. And also it will be going to be beneficial for every other members of ICAI, sir. At the end, I would also like to thanks again to the Pune branch, Ludhiana branch and Jammu Kashmir branch to jointly co-hosting this webinar at this level. Definitely, sir, both the speakers going to help the members and going to unlock the several aspects of international taxation during this lockdown period, sir.
Thank you, Moiji, and thanks to all the members of all the branches for hosting this very interesting webinar. It was good to interact with members. Thank you very much for providing this opportunity.
Thank you, sir. Thanks a lot. And at last, thanks to each and every members for viewing this webinar. Thank you. Thanks a lot.